Hi, this is Randy Finney with Right Side of the Chart. Today is Friday, June 21st, 2019. It's about 1:30 Eastern Time as I'm starting this video, and I wanted to do an update on gold and Treasury bonds, the two king of risk-off assets, we call them. Now, you might wonder why they're both rallying, and the stock market is as well. Well, I commented on that, I believe, yesterday, and recently it's quite unusual. Usually, you'll see, gold. There are two things that affect both gold and treasury, a couple things, but one of those is they are, as I said, flight to safety instruments. When people get worried about the stock market, the outlook for the economy, they will flock into gold. Gold is also considered an inflation hedge, but we don't really have inflation right now, or at least it's not showing up yet, or so the government tells us. Again, that's a whole other thing, what they report and what we're all seeing in our, over the last few years. I've seen tremendous amount of, increase in costs in healthcare, digital services, things that I don't even know if they include a lot of that stuff in there. It's pretty comprehensive. You can Google what's in the CPI, but all right, let's get away from that for a minute, and I'll just say this: that gold is rallying now for both those reasons. The economy is softening. A lot of economic indicators rolling over. That's why the Fed has gone easy now, and more so is the euro US dollar. So if you're new to the site, just go back and show you some charts. I've been covering these for many months, even well into last year, over a year now, highlighting this big, beautiful, symmetrical triangle pattern with a very nice, well-defined downtrend line on gold. So long before this thing broke out, even when we were at the bottom of it, it's been highlighted, and I said this is where you get the next buy signal, and so I've maintained these price targets for well over a year now, and I wanted to do the video because for the first week we've now hit and slightly exceeded that 130 target. So it's been a long-term target. You can see we broke out of the wedge, we back tested. It's just perfect technical analysis. Overshot it right now. I think that's going to be a momentum fueled overshoot. I was and still am expecting a reaction around this level. We don't have to get it. I'm going to talk on that in this video too. Sometimes my confidence is high, and I might normally reverse and short gold here. I don't have any desire to short gold, and I haven't for a while. This is a core position in my long-term accounts that I've been building up, scaling into for a while, and I think it's I always talk in the benefit of both diversification and asset allocation. This is a, in my opinion, a nice sliver of that pie, a piece of the pie, and the pie being your whole entire portfolio, with various sectors, stocks, commodities, things like that, bonds. So that's it. So there we're at the 130 level. We've overshot it a bit. We overshot it there a bit. We overshot it here a bit. I think it's still a significant enough level that we are likely to get a reaction. But again, my confidence on the reaction isn't as high as it usually is, where sometimes what I mean by that is I micromanage trades. I might close out all my gold long positions and then reverse for a short, try to buy it back in. That's called gaming a reaction off when a price target is hit. But right now, again, I'll go through the charts and tell you probably best to ride out any pullbacks for the near term. But again, we'll let you guys make that decision. But you can see all the reactions again off that level, so it's not arbitrary. And gold is, you can see, the most overbought we've been in all the way back here to last time gold was in a bull market, which I maintained it's now we can say. And there's a lot of updates I need to do in gold. I've talked about this for a long time. We couldn't say definitively that we were in a new bull market after this low here. That was a big bear market in gold. Gold topped back in 2011. And the reason I said that is because the definition of an uptrend is a security making a series of higher lows, which gold was certainly doing, and higher highs. And up until this point, because we were in this triangle pattern, which is a pretty powerful pattern, we needed to take out 130. Now we have a higher high from that previous high. So at least by that definition, gold is in an uptrend, and quite likely in the relatively early stages of a new bull market. So that's that. That's the long-term charts. Here is, let's look at this. Maybe I'll post a link to this video again for those that are newer to the site. I've done a lot of analysis on gold, GLD, and to do that, if you want to find what you're looking for, if you haven't seen anything on gold for a while, two ways to do it. Use the search function in the trading room. It's on the right-hand side of the trading room, That'll give you a kind of a wide search. There's also a search bar up on the top of the site. Keep in mind that anything I post in the trading room, which is 90% of the charts and analysis I post, that's going to require gold access. You might get a hit on that, but if you click on it and it says content protected, that'll be gold only. Here, instead of talking about it, let me show you what I'm getting at. So any posts that I make on the front page, this is at again, I'm picking one example back on March 11th, 2019. Below the post on the bottom, you're going to see this all this information. These are tags, and if you see I highlight as I move my cursor, it turns into a little hand, and the links then change color. That means that's a hyperlink. And so if I click on any one of those, you can click on a commodity like forex currency, gold and commodities. Those are categories, I should say, right there, and those categories are up here as well. And then these are what I call symbol tags, and you can, again, if you want to see analysis, catch up on analysis on gold, click that, and what it'll do then is load any front page post, so gold or silver members. Any of those tags are always accessible to both silver and gold members, because those are front page or blog posts, and you can go down and pages and pages. So if you want to catch up on previous analysis, that's how you do that. And then as far as a trading room goes, if you want to search something, this bar here has that big pop up, and you can do, again, GLD, type it in, it'll auto load, you don't have to click anything, and you can see these are trading room posts, and you can see who posted it, and you can see the date there. And if you use a scroll wheel on your mouse, which I'm doing, scroll, it's going to go back in time, show you all. These are front page posts. When you see these charts like this or just a title, those are front page posts. So that gold members can get to that as well. So again, I think it's more efficient to use that search by ticker symbol. You can also go on the resources page down here. There's that box to select your symbol tag and just type in GLD, which I just did on my keyboard. It jumps down to gold, and that's another way to find what you're looking for if you don't have the symbol tag to click on from a post. Okay, so back to that again. This was just a screenshot from that video back on March, and showing you that we're back testing here, and that was bullish, breakout and a back test. So you have, in trading, you can go long on a breakout or on a back test and go up to the 130 level. And in the same video, I also covered GDX, which is right there, showing my target on GDX at $25, and so I expected both to be hit around the same time. So that was then. This is now. What is that? Several months ago. Let's fast forward to today. There's gold. Like I said, a little momentum carry through. May keep going again. So I can certainly make the case for it. And GDX almost to the button. So this isn't mere coincidence. This is technical analysis. That is not just a magical number I pulled out of a hat somewhere. It's a very well-defined resistance level. It is significant technically, as is that level on gold. And so GDX is here. Now what does this tell me? Well, number one, besides the target being hit, is right now isn't the most objective time to add, because you're at resistance. TA 101, Technical Analysis 101, says you either sell a rally into resistance or you wait for a breakout above resistance. And being that we're getting pretty stretched now, if gold and GDX is in a new bull market, can't say that yet. GDX still has a high from back here, 2016, it never took out. But I just made the case that gold is, and make no mistakes about it. If you want to know where GDX is going, all you have to do is know where gold is going, because the miners will always follow the metals. There are temporary disconnects, but they are what I always refer to as just simply a leveraged play on gold. What do I mean by that? Well, during a bear market or downtrend, they drop more, maybe twice as much as gold. There's no set ratio. And in a bull run, they go up more than gold, because miners are essentially, if you think of it this way, they are a leveraged play on gold. Why is that? Well, what are they doing? They're doing one thing. They're pulling gold out of the ground, right? And so their costs don't really change. They've got labor to meet, trucks to run, things like that, operational expenses, utility bills. Those are fixed costs for the most part. They ramp up production. Yeah, the fixed costs go up a little bit. But what happens is the price of gold doubles or goes up 30. Let's say just say 30%. Their profits have just shot up tremendously, because what they're pulling out of the ground has now cost that much more. So anyways, that's why you get such a run in these gold stocks, and such a drop if gold's going the other way. All right, so again, charts are the charts. So what we know, we're overbought, In a bull market, overbought tends to become much more overbought, just like in a bear market, oversold tends to become more oversold or stay oversold for a period of time. But it is sort of a heads up that, hey, we're at resistance after a pretty strong run. The miners might need to take a breather here. So, if you get a pullback, certainly might be a good time to add to some of those positions. Or, the ideal scenario would be some consolidation, whether it's a little pullback or some sideways trading for just a little bit to work off the overbought conditions and then start to clearly walk away from that level. The other thing I like to do is look for solid weekly closes above a resistance level, since this is a weekly chart. Right now we're right on it. There was a little pop. So again, and you can see the same big old triangle type pattern in GDX as we had in gold. So again, not by coincidence. As I said, the charts are pretty much gonna mirror each other, and that's why both GDX and gold hit my targets from over a year ago. Hit them both this week. It's not by coincidence. It's because they moved together. Okay, changing gears a little bit, as I always say, this is just me. I believe any analysis of gold is incomplete without analysis of the US dollar. I like to just, for whatever reason, I like the euro US dollar currency pair, the Forex pair, because the euro is the biggest component. It's nearly 2/3 of the US dollar index, so it doesn't matter where the Swiss franc goes or anything else. It's euro drives the dollar index, because remember, the dollar is not a currency in a vacuum. Its value is relative to other currencies around the world. That's what makes the dollar and the exchange rates what they are. So, as I've been highlighting again for over a year now, beautiful bullish falling wedge, positive divergences, everything I like to see. Just like I was bearish on the euro back here, bullish back here at the lows with the big divergences. These are your big trends. If you're patient and you can sit back and not get shaken out on the little moves, and you can wait and see these big trends set up, that's where the big money's made. In this video, these weekly charts that I'm talking about now are really the realm of the long-term investor, trend trader, those that don't want to mess around with these in and out 60-minute charts, 15-minute charts, things like that. All the little micro zigs and zags in the market. So what's happened recently is we had a solid breakout. It's important when I say solid or impulsive breakout, because breakouts that are impulsive have a much higher rate of sticking and not failing. You get little, that was an intra-week break, but again, that was a solid breakout. We came in and back tested, and we're moving back up. It's a little bit of resistance here, and you also have this 40-week EMA that may come into play. It has so far. You can see back here, it's capped some of the advances. It hasn't done a perfect job, because you can see the pair sliced through it there, but once we got above it there, stayed above, we were in an uptrend, broke below it, and it has capped some advances recently. So this is another reason. Longer term, let me be very clear in case this is confusing. Longer term, I am still bullish on gold, still bullish on the euro, meaning bearish on the dollar. Intermediate or very short term, let's say neutral to maybe even slightly bearish, but not bearish enough to short. I just say we're at some resistance. And again, that does not mean, this is a pretty powerful pattern. And sometimes when these things break and you have all that, it's like think of it like a coiled spring with energy building up as prices compress in the pattern. When you break out, that's pretty powerful. And sometimes you can just blow by the first few resistance levels like they're not even there, and you can see where my next stop is for the euro US dollar once this level goes. And then on the daily chart, again, the technicals have just been really nice. I haven't modified these trend lines in ages. So you had, intersecting, you have a longer term trend line here, and then a little bit shorter term trend line there. And you can see we had a breakout, pulse of breakout, hit that 113-ish level, came back tested, which I highlighted recently, and then boom, we're moving higher. My next target on the daily chart is this downtrend line, and then I have a resistance zone around right here. You can see those two levels there. And then ultimately, this is the next one. I'll probably turn that line up a little brighter now. And so that's where I think the euro US dollar is going. And again, if you reference that video from March 11th, there's plenty I've done this, but in that video early on, I put up a chart comparing the US dollar to gold and showing that very, very clear inverse relationship, meaning when the dollar drops, gold goes up and vice versa. So this euro US dollar chart again is just like the dollar in reverse. You can trade. Dollar has an ETN called UUP, and so on UUP, which is the dollar index ETN, it's just that bearish bullish falling wedge that we looked at on the euro, only in reverse. You get a bearish rising wedge because again, when the euro goes up against that on that euro US dollar chart, it means the euro is rising against the dollar. And so here's your breakdown in the dollar. And that's again why at this point I think this is a major breakout, one that I've been looking for years. So early on, I don't care to try to game pullback trades like I might normally when I'm trading a trend, within a security. I might be longer term bullish and then, try to game the pullbacks and then get long again, but not now. I'd rather just sit tight and look to just add on pullbacks, really. And and I did lighten a little bit of exposure on gold here just to kind of, in case we do get a pretty good pullback. And I'm going to roll into something as well, and when we get to treasuries here, if there's time in the video. If not, I'll just do video. If not, I'll do a separate video on treasuries next. And maybe that's it for gold. Like I said, not much more. I'm focusing largely on those weekly charts. And again, here's another reason I don't care to game a short right now. Gold, GDX, I can't make a case for short. Overbought in itself is not always a case. It is a heads up. Hey, things are getting stretched. This is the most overbought the miners have been in years. I pointed this out back. Whenever this triangle pattern was, symmetrical triangle. Boom, we popped above it, and boom, it's just been a unidirectional rip. And what I'll do here, it's a little off topic, but I always talk about the decay, and this is in the FAQ page on the site. Go into the resources page. We have a frequently asked question section, and you go under ETFs, and I talk about decay. And most people think the 3-time leveraged ETFs are you're guaranteed to lose money if you hold them for anything more than a very short-term trade. And while that is most often the case, it is not always. And in fact, I haven't done this yet. I haven't done these measurements, but I'll do them for you right now. But the point I'm trying to make is the 3-time leveraged ETFs can actually give you better than 300% return on the underlying instead of worse, like most people think that they're guaranteed to do, if you catch a unidirectional, what I call a unidirectional trend. What's unidirectional? Meaning pretty much very few kickbacks, against the trend. That's a unidirectional dip right there, all the way down to here. This is most certainly a unidirectional rally. Doesn't mean you can't have any givebacks, but for the most part. So let's measure it out. I'm going to grab the bottom of the candle right before we took off here. That was on May 30th. From there, we broke out of the triangle pattern that day, or the following day with a gap. I have to get the bottom. You can see the little, here, and get a little tighter here. You can see if I catch the bottom of that candle, the measuring tool is on the pop-up box to the left down there, 23.4%. Now let's look at Nugget, which is the 3-time leveraged ETF for the miners. So what was that? What did I just say? 24%. So you're talking should be about 75%. Aha, there's 83.5%. And that's really a relatively short time period. So not only did Nugget do better than 3 times what GDX did, or at least match the 3 times. In other words, there was no decay at all. We actually outperformed, or it outperformed. So just kind of a... Now, what do you do with that? Well, you wait. If you're going to use Nugget or Dust as a swing trade, you wait till you have the perfect setup, and you have a very high degree of confidence. There's a chart pattern, a breakout, everything needs to align. The euro, the US dollar, gold, Nugget, GDX, but again, they're the 3-time leverage ETFs. They have a bad rep because you don't want to hold it in a choppy market, and certainly you don't want to hold them when things are going against you. But that's sad. I just wanted to point that out, that you can use that leverage at times. And if you're wondering how that works and why it works, the math again is explained. I do the math on the FAQ page as to why a unidirectional rip will outperform more than the 3-time leverage factor that you have on the ETF. Okay, as I have a few minutes, we're still under the 20-minute mark, and I'll keep this quick. Same thing on TLT. This is a chart that I've made very few modifications to any of these trend lines or my expectation. This is a 10-year weekly chart on TLT, and you can see it's simple. The same premises that apply to stock trading or trading gold or anything else apply to just about anything that you can chart. These are treasury bonds. They have nothing to do with stocks or the stock market, or very little. They're not equities, but you look for the same thing on the week. Since it's a weekly chart, these divergences span many months or even years, so they're good for investors, trend positioning, IRAs, 401k money, swing trading time frames of the 60-minute charts, daily charts. Although this can set the stage, and help align those trades. But again, these are the biggest drops that we've seen in the treasury bonds in years. These two drops, and they were both clearly, telegraphed in advance with these negative divergences, big divergences on the weekly time frame. And again, the sell signals. There might be some sell signals here on the weekly with bearish candles, but you really hone down your entries and exits using the daily and intraday charts. But so what happened after that divergent high? It put us in a downtrend, and that downtrend formed this bullish falling wedge pattern. So we had a couple things happen. First of all, after that divergent high, we have this uptrend line, very important uptrend line. Look at all the reactions along it. We danced on it here, finally broke down. And when we broke down, so there's cross currents here. That was bearish. That's the primary uptrend line in TLT. We broke down, which is longer term bearish. However, we set up in this intermediate, well, more than intermediate, it's pretty long term because it goes back to 2016 where it started. But this is a bullish falling wedge pattern, and yep, you got it, bullish or positive divergence down on the indicator. So for well over a year now, I was highlighting this, saying, here's my plan or expectation. We break out, we hit my first target at 122.50, come on in, back test, which we did. We broke above 122.50. Remember, resistance once broken becomes support. So we were pretty stretched on that run. We came back in, back tested the 122 level. 122.50 level almost perfectly, and then boom, voila, at my target all along. And it was, I started it back here, so at the time I had the 128.56 level and the trend line came in about together. Took a little longer to get there, so I always said way back then that my target was either or, the 128.56 level or the back test of the trend line, and that's what we've done. So where am I going with this? Well, I have now moved out the last of my treasuries. I should hit on corporates too real quick, because most 401ks, those are your options. You have either corporate or treasury bond funds. They don't give you junk bonds. I'm speaking generically. So as far as bonds go, we'll hit it today. I'll cover that. So here it is. TLT has now hit my long-term target. What else? That is resistance. That's a back test of a trend line. We're also overbought. The last time we were overbought, or last times, 1, 2, 3, I won't skip any. This is a 10-year weekly chart. So with zero exceptions, let's see what happened. Let's see how good you did if you stayed long or went long treasuries for the past decade every time. I might have missed that there. Let's clean that up. That one right here, that first overbought is this. And that drop, by the way, so I'll measure it for you. It might not look like much, but that was a 12% drop in treasury bonds. Then we pushed up again, did it again there, and we had probably 20+%. So again, these are just simple things, and if you sit back and you're patient, the timing on these weekly charts, you're not going to get exact timings. You're going to get in a little early or out a little late. Out a little, possibly out a little early, I should say. But that's what I wanted to highlight. All those overbought readings, and again, 1, 2, 3, 4, 5, now 6. So if we happen to go up another 5, 10, 15% without anything happening, this would be the first time in the past decade plus where we were overbought, and soon can be weeks, can even be a couple months, but percentage-wise, I don't think there's much more upside. Now, it doesn't mesh so well with my outlook on the market because treasuries are a flight to safety asset. So I mentioned this in the trading room today. I shorted treasury bonds today via futures. I'll get to that chart in a second. I did that for two reasons. Number one, first and foremost, based on the charts. To me, the charts confirm the short entry, but it is also a hedge because whether or not I extend the stops on the QQQ trade today, the official trade, I'm going home short. There's enough in the charts I'm seeing right now that I'm taking my index shorts home. What happens maybe next week, the market pops and rallies hard. So I'm viewing a short on treasuries as both a hedge to my index shorts. Why? Because we're stretched. The technicals say a correction's likely, and if the stock market continues to rally, this is very unusual to see both treasuries and the market rallying. This is a red flag, by the way, for the market. So I expect a pullback in treasuries. It's just more of a tactical trade, at least as of now. Maybe it morphs into something more. But again, there's a lot of evidence just here on the weekly chart alone. If I go to the daily chart, yeah, let's move this line. That's a divergence line, but we have this smaller divergence here that shows through on the 60-minute chart, and that would be right here. So you have this divergent high, you have a doji candlestick there, followed by a red candle today. Check, check, check. There's a lot of evidence, and I don't know, maybe I'll even add TBT as a short trade. TBT is the 3-time short treasury, long-term treasury bond ETF. Where treasuries going, in my opinion, probably back down here at about that 128.55 level, and or that uptrend line here. I think that'll come into play. So again, it's a twofold trade. Maybe the market corrects and treasuries also pull back. Let me show you the chart that I posted in the trading room. It was this one, ZB. These are treasury bond futures. If you're, trade futures, again, it's the same thing pretty much as doing TLT, except you have some more leverage here. So you can see the reasoning for my trade there. Right here, we broke down. This is a rising wedge pattern. I had a little whipsaw there, but it cracked today. I like this one better, and that's why I entered a position. I also want to go home kind of hedged over the weekend in case the markets do pop up and put my shorts more underwater next week. And if that happens, if the market rallies, I have a high degree of confidence we come down here at least to my minimum target, which is 153.068, and or you have a uptrend line support here. I think they'll both be hit. So I think it'll play out something like that. Go down there, have a reaction, hit that. And quite possible if the market continues to rally, then I'll stick with this trade and shoot for this target right here, and maybe even more if the market continues to rally. I'll be out of my shorts by that time, most likely, but this is the potential for this trade right now, and that's not a bad move. That would be that drop down there would be 5.25%. That might not, what is it, 5.7%. Even this minimum target down here is about 1.6. I know that's not exciting, but these are treasury bonds. You trade ZB, it's levered up big time because treasury bonds are inherently less volatile than stocks. You can take a much larger position size. I take at least, if I were to trade TLT, at least twice what I would take in SPY or QQQ as far as my position size goes. All right, so let's look at one more thing. This is ZN. These are the 10-year. This is a 10-year Treasury bond futures. You can see then whipsaw signal recently, but now it's broken down again. It's pretty well-defined trend line. And on that, your options are IEF, 10-year Treasury bond fund ETF. So I could do the same thing here. There's that uptrend line right there. There's our small divergent high right there, just like TLT. You get a little more bang for your buck usually because of the longer maturities in TLT. That means their bond prices will move more. They're more sensitive to rates. But you can see a pullback target here. Actually, you can see here, this was my long-term target. Actually, we had a trade back here. It must have been on the breakout here. Whether it was official or unofficial, I had 1, 2, 3 price targets. My final swing target 107.90. So just like Treasury bonds, we kind of hit that on TLT. I mean the long-term bonds. We hit, popped, and so now that was my final target. Then we're a little bit above it, and I think we come on back and back test it now that we overshot it. So that would be a short-term. Again, let's just look at it right now as a tactical trade, a quick pullback trade, and again a hedge to any index shorts. Okay, we'll wrap it up here with LQD because I'm certain that at least some of you listening to my voice have 401k money, and in those 401ks you probably have some bond funds. LQD is the investment grade corporate bonds. You have your junk bonds, anything triple B or lower, or below triple B, I should say, and then investment grade bonds, that's triple A down to the triple B ratings. And this, to me, this chart is it's a beautiful chart. Why? Because look at this rally. Look how extended. Look how overbought we are. Last time Corps where this overbought was right here. In fact, let's go over like we did on TLT. Every single time we crossed above or hit that 70 level on the RSI. And now you decide what you want to do with your bond funds in your 401k right now. I can tell you what I did with the ones nope, That one was not. It was right here. Okay, so we had a double tap reading. That was it. 1, 2. So scratch that one right there. That we didn't get oversold, but we did there. Almost right there, but looks like we fell a little shy. We did there, and now we are. Oh, I keep saying oversold. For some reason, I always get those two flipped around because I'm either looking at a stock that's oversold or overbought. These are overbought readings. There's that 70 level in the RSI. This is again 10 years with virtually no exceptions. You had a little blip here, but it was certainly a correction worth getting out of the bonds. We had one more thrust up and then the big drop. So to me, trading is all about just putting the odds in your favor, and what technical analysis is all about is looking at past chart patterns, history, what securities did things at similar points in the past. That's what we look at. All technical analysis, all the chart patterns we use, breakouts, wedges, head and shoulders, cup and handles. All these patterns are just patterns that have over the years have been recognized, and they work more often than not always. So to me, great time to exit corporate bonds. Take some profits, take them off the table. You want to stay properly diversified in asset allocation, because your question might be, well, Randy, where do I put money? Remember, you can just take the piece of the pie down. If this is, if you're a somewhat conservative long-term investor and you have, let's say, half your money in bonds right now, and let's just say they were all corporate bonds, you just take that notch down. You can still leave a piece of the pie there, but you might not want to add any exposure right now at this point in time. See what happens here. Or again, take some profits off the table. That's been a hell of a run. Your corporate bond funds, if you haven't touched them all year, they're up nice. And you're going to say, well, they pay decent income. Well, yeah, you're probably getting, I don't know, 4% interest at most on a corporate bond fund right now, somewhere around there. And if you drop 10-15% over the next 6-8 months in principal, you're going to lose money despite that annual dividend, because you got to be in it for a year to get that 4%. And this thing could easily pull back here. Let's just say my minimum target's about 122. It's at 123.62 right now. So I don't know if I would make a case to short it. I don't see it here on the 60-minute. And I can't make a strong enough case on the daily, although that's looking a little toppy. But like I said, a pullback trade. I think it'll come back to right here, about 122.70. That's about a 1.5% drop. So may or may not be worth it to you if you want to sidestep. But again, to me, I think it's time to just lighten up there on corporates. Okay, long video. I probably should have separated the bonds and the gold, but again, they tend to often, not always, but often trade together in their flight to safety assets. And so of the two, if I had to be in treasuries or corporates for the next year, for me it would be treasury bonds, because you don't have the credit risk. Corporate bond market is dangerous right now, in my opinion. We are at a point unprecedented in history where the bulk of a huge amount of the issuance has been the lowest investment grade, right at that triple B level. And when the economy starts rolling over, and if it continues to do so, those bonds will get downgraded. What does that mean? Big deal, they're junk bonds. No, it is a big deal, because your bond fund manager that runs your investment grade bond fund, I'm generically speaking, but most of the bond funds, if they're by prospectus, they're required to only hold investment grade bonds. They have to then turn around and sell the bonds that they already hold that were downgraded to junk status. That will trigger a cascading effect. As more and more funds sell, more and more bonds, it puts more and more pressure. So be careful with corporate bonds, especially. You're not going to see that in treasuries. But it can happen in the corporate bonds. I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.